Good day, everyone. Thank you for joining us and welcome to today's session on the war on Iran and its impact on African financial markets. I'm Natasha Senkge, Head of Research at Mazi Asset Management, and I'll be moderating today's discussion. I'm joined by my colleagues from the Mazi Africa team, Keonethebe Bosigo and Moses Njuguna. Great to have you both. Perhaps you can each briefly introduce yourself and share your role with the audience.
Hi, good morning, everyone. My name is Keonethebe Bosigo. I'm an analyst and a portfolio manager for the Mazi Africa Fund.
Good morning, everyone. My name is Moses Njuguna, analyst at the Mazi African Fund. Thank you for joining us.
Thank you, guys. So the objective of this session is to take a step back from the daily noise and unpack what the conflict means specifically for African markets and investors. We want to connect the macro environment to practical portfolio implications, unpack some of the challenges and some assumptions, and ultimately leave you with an actionable insight. So maybe just to set the scene a bit, and before we dive into the current dynamics, I would like to start with a quick reflection. So Keo, can you please give us a brief overview of how African markets were performing before the war and what the key drivers were at that point?
Yeah, thank you, Natasha. Pre-war, if you look at the African markets, actually for the past 18 months, a lot of reforms happened on the continent in 2024, where some of our biggest markets like Nigeria and Egypt took the steps to fix their currency markets and their economies. A lot of reforms happened there. And since then, the African markets have been on a good footing. We saw markets actually double and in other places more than double in the past 18 months. And you look at, the beginning of the year, January 2026, the market started also on a good footing. We saw African sovereigns or countries raise about $6 billion in the Eurobond market, led by Kenya, which raised about $2.25 billion by end of Feb. We also saw the equity markets rise significantly in the first 2 months of the year, mostly driven by the country's own idiosyncratic risks, or you can say country's own reforms agendas and growth trajectories.
Thank you, Keo. I guess let's move into Operations Epic Fury, which began end of February this year. And I think since then, we've seen significant volatility across global markets, with African markets responding in quite, I would say, differentiated ways. Again, Keo, from a financial markets perspective, what was an immediate reaction across African markets when the war broke out? And how has that evolved over the last, say, 2 months?
Yeah, thank you, Natasha. The outbreak of the conflict triggered, as you can imagine, an immediate and multi-channel shock across the financial markets on the continent. If you think about it, you actually have to break it into 2 parts. There was the first week of the war. The reactions were sharp and largely indiscriminate. There was a sell-off across the continent. However, as week progressed, markets began to differentiate, highlighting that Africa is not a monolith. It's not a country. It's actually a continent with 54 countries. In the initial reaction, we saw oil move from about $75 to about 100. It peaked at about 120 post the Operation Fury. As Iran closed the Strait of Hormuz. As you know, about 20 to 25% of global oil passes through that strait. I think about 20% of LNG also passes through the strait, 35% of fertilizer and other important chemicals like helium that affects our day-to-day lives and passes through the strait, but that we're not aware of. There was FX pressures all across with oil importers. This is where now the market started to differentiate between countries, where we saw oil importers like Egypt, Uganda, Tanzania, so SA facing immediate depreciation in their currencies. Kenya is an oil importer, but they managed their currency very well. It was stable throughout the period. However, we saw oil exporters like Nigeria, Angola, and Ghana experiencing stable currencies and in some places currencies strengthening. This was on the currencies, and then if we move on to the bond market, we saw oil importers experiencing a significant sell-off. I mean, we saw between 50 and 200 basis points yield uptick in the net oil importers on the continent, whilst the exporters saw their sovereigns actually strengthened in some cases. Whilst also there was a divergent performance in the equity market with the oil importers like Ghana experiencing significant uprising in the equity market post the decline, of course, in the first week, and Nigeria also saw the equity market posting positive returns for the month of March, while the other net oil importers like Egypt saw significant sell-off. I mean, just in the first week of the sell-off, Egypt saw almost $4 billion of treasuries being sold off, and the EGP moving from 46 to 54 to the dollar. Yeah, Moses.
Yeah, I mean, just to add to what Keo is saying, especially on the exposure that Africa faces from, this conflict in terms of oil. A lot of countries in Africa are oil importers. So, I mean, getting ready for this webinar, we did a bit of research, and according to the African Union, they have a division that focuses on energy. It states that Africa imports about 56% of its total oil product supply. Africa basically accounts for 7.2% of global reserves, and the amount of crude oil that is produced within Africa, only 25% is refined on the continent. This is before Dangote's refinery came to play. So this basically highlights the sort of exposure that Africa faces by relying on imports from mainly the Middle East in terms of refined products. So that led to a significant pressure in FX. The exposure to basically higher oil prices will definitely impact some countries that have basically very little adequate reserves to basically support or defend themselves against these exogenous risks. So Africa is highly exposed to these high oil prices, but we think that there could be opportunities for us, and like you mentioned that the oil exporting African markets like Nigeria, Angola, we've seen the markets remain quite positive, and that's encouraging from where we sit. Thanks, Kyo.
Thanks, guys. And maybe just to unpack on the macroeconomic dynamics and shifting gears a bit to the fiscal dynamics. Kyo, so African governments are entering the shock from call it a very different fiscal standing point. How are you assessing the fiscal resilience across the continent? And what are the key sort of warning signs that you're watching on a continuous basis?
Yeah, you are right, Natasha. The African markets entered this crisis on different footing, with some markets having better balance sheets than others. And like we said, I mean, the shock has been, the impact of the shock has been quite divergent between the net exporters and net importers. Let's look at the transmission channels, for example. I mean, trade, we start with the trade balance and current account. I mean, for importers, which makes up the majority, as Moses mentioned, of the African economies, including East Africa, Egypt, and SA to an extent, and some of the Sahel countries. I mean, the import bill has blown up, you know, and current account deficits have widened, I mean, posing significant risks to their currencies, and also external debt costs. When it comes to the fiscus, also the impact is also as divergent, with the net importers fiscus being under pressure. And we saw this. The guys that had weak balance sheets or weak external balances, their bonds and in equity markets sold more aggressively than the markets that had a more stable balance sheets. And reforms here have come in handy. You look at markets that reformed in 2024, you know, like Nigeria, like Egypt, you know, they entered this market in a much better footing, you know, not because just because they reformed, you know. So hence the external impact on their balance sheets was much muted. And if you look at the inflation and food prices, especially for net importers, I mean, inflation is going to be there for everyone. Inflation is going to increase in both the net importers and the net exporters. But the difference here will be that the balance sheets of the net importers is going to be impaired, and this, especially if the situation continues for long, you know, it will see the cost of funding in most of these markets exploding, putting pressure on their local economies and consumption in their local economies, while the exporters will be able to weather the storms better because their balance sheets will improve. And some of the biggest risk from the fiscal perspective, Natasha, that we're looking at is that we're looking out that countries, especially the countries that have taken the difficult steps of reform, they must not go back on those steps, especially on what we call on subsidies. You know, once we see countries going back to subsidizing fuel or other things, for us, that's the biggest risk, because it's got longer term implications for the country's fiscus. You know, but I mean, we've seen on the positive side, we've seen markets like Egypt, which has historically subsidized a lot of the products in their country, raising fuel prices by 19% in the first week of the war. And we've seen countries like also Nigeria, though a net exporter of crude and also post the Dangote refinery to be a net exporter of finished product, raising their fuel prices immediately to react to that. Yes, it will raise inflation, but I mean, over time it will come down. So on balance, what we're seeing, the behavior of the African markets is giving us a very long-term positive outlook.
Yeah, thank you, Kyo. Yeah, just to add on to that, I mean, on the fiscal side, like you mentioned, the oil importing countries are under pressure. And incidentally, I mean, with the higher oil prices that's expected to lead to, you know, higher inflation that will filter into higher cost of funding, we've seen many of these countries, you know, turning inwards in terms of funding. So we've seen, you know, domestic bond markets, you know, being active. I mean, these, you know, just for example, like in Kenya, they have been raising their funds mainly from the domestic end rather than externally because of the costs. and we've seen that across sub-Saharan Africa. So, according to the IMF, this is one of the strategies that sub-Saharan economies are using to basically sort out their fiscus, as well as, liability management strategies, which basically includes buybacks. We've seen that happening on the with Kenya, where they're buying back, portions of their euro bonds early and lengthening their maturities as a way of reducing the pressure on their fiscus. So we've seen some of these African regimes looking at ways of reducing the pressures on the back of this Iran situation, as well as pressures that they had faced even before the war. So the war basically added significant pressures on fiscus of some of the countries around Africa. Thank you.
Moses, maybe just on, Africa has had long-standing relationships with Gulf countries that are affected by the war. We've seen significant investment flows from the Gulf sovereign wealth funds into Africa. Historically, that has been playing out. Now, with the Gulf economies now under pressure, how does a potential pullback in that capital affect the fiscal and sort of investment outlook for African countries?
Yeah, thank you. Thank you for that, Natasha. The Gulf region has been very, very supportive for certain parts of the continent. A country like Egypt, they have relied a lot on GCC inflows for funding gaps. And with the risk of what's happening in the GCC, weaker economy, certain portions of their critical infrastructure already attacked by Iran, this basically highlights that we should expect, a pullback of fiscal pressure on economies that were relying on the GCC in terms of support. Another point would be, a lot of these funds that the GCC were pumping into Africa, we've seen, I think they announced about $100 billion to African infrastructure and investments. If that money doesn't materialize, this basically means that we should see a slowdown in infrastructure growth in Africa. Just to put in perspective, the Africa Development Bank basically states that Africa needs about $360 to $400 billion in infrastructure investment, and this is on an annual basis. So in terms of shortfall, we're talking about 130 to 170 billion. So just put in the context that what the GCC are putting in of $100 billion, it shows you that this is a significant chunk of the shortfall that Africa needs on an annual basis. So any reduction of that, or the risk of that money not materializing, will impact infrastructure growth, across the African continent. And what would this mean in terms of logistic costs? Because several countries don't have have poor infrastructure. According to the World Bank, this poor logistics and poor infrastructure, basically on the transport only, would lead to about 30 to 40% increase in food costs. So it is a knock-on effect with regards to the risk of what these Gulf sovereign wealth funds, $100 billion not materializing. Additionally, entities, if you look like, I'll give an example, like in Kenya. Kenya has about 400 to 500,000 Kenyans working in the Gulf region. So in terms of remittances, the Gulf region is very, very important for the reserves, international reserves for Kenya. So any impact, any negative impact on within that region basically will impact the amount of reserves, remittances coming into the country, and will affect, the reserves buffer that the country has. A lot of African entities, African countries have, their diaspora in the Gulf region, so that may impact their reserves buffer, and the reserves buffer is very important to absorb any exogenous shocks. So long story short, and in conclusion, we think that this risk may lead to maybe widening sovereign spreads, basically to reflect the pressure on the fiscus, to reflect the slowdown in infrastructure growth, to reflect the impact on hard currency inflows or remittances coming into the countries, may lead to weaker currencies, FX pressures, and possibly lower investor confidence. So there would be an additional premium from international investors when looking at economies that are relying on the Gulf region in terms of support, or any pullback from the sovereign wealth funds to invest within the African countries. So that is a serious concern, and it is a serious risk that we are closely monitoring. Thanks for the question, Natasha.
Yeah, and just to add there, Natasha, I mean, on to highlight the implications or the seriousness of this issue. I mean, we've already seen the UAE, the impact of this war on the Gulf. I mean, the UAE is already asking for swap lines, for example, with the US government already. So it just shows you that there is a real impact on the economic outcomes of the GCC of this war.
And maybe just closing your comments on the fiscal position, how are you thinking about debt sustainability in this environment? Keo?
Yeah. That sustainability in this environment, it all goes back to how the countries are. I mean, the countries were positioned entering into this environment. Markets like Egypt are the most at the most vulnerable, because firstly they have very high net debt to GDP. I mean, you look at things like debt to service ratios. Countries with high debt to service ratios like Egypt, like Kenya, are the most vulnerable in this environment, especially with what Moses has already talked about with regards to the Gulf pooling of investments due to this environment. However, countries like Nigeria, which already, even though they had a high debt service cost as a percentage of GDP, they had a relatively low net debt to GDP. So which puts them in a much better footing in this environment, not only because they're benefiting from the higher oil price, but because also they entered this environment in a much better fiscal footing. So yeah, different countries will be impacted differently by this. And the other risk that we need to look at talking about debt is like the FX composition of the debt, or foreign component of the debt. The countries with higher component of their debt being FX will be highly impacted. And it goes back, I mean, if you look at the trajectory or the group of countries is almost similar. You look at a country like Kenya, even though most of that sovereign debt is with bilaterals, at least there that's a cushion. But I mean, if you look at Kenya, 50-50, they've got 50% of their debt in local currency and 50 in the FX debt. But out of the 50% FX debt, that 50% or 25% of that will be with bilaterals and multilaterals, which is more stable, low cost, and it won't react to this impact. But the 25% that is raised in Eurobonds and commercial loans, that's where the hit is going to come. Because I mean, the impact of weakening currencies, most importantly, I mean, it accentuate the debt positions of the country. So the impact is not uniform across the continent. Some countries will do better, while some countries will struggle in this environment. The other important fact that we look at this is the refinancing risk. If you look at, I mean, S&P currently estimates that approximately about 90 billion of African sovereign maturities are due in 2026 alone, led by Egypt, which 27 billion is due this year. Angola, SA, and Nigeria. I mean, SA and Nigeria, I think they'll be able to handle that fairly well. And Angola, because because of the windfall of the higher oil price. However, Egypt is going to need much more support. But I mean, there are things that are happening there also. They are on an IMF program, and they are on a reform trajectory where they are selling. They'll be selling off. They're supposed to sell off government assets or SOEs, and we think that this current environment will accelerate that reform for them to fix their balance sheets. There's also, fiscal credibility that we have to look at. This government with clear reform agendas on an IMF program, central banks, they will be able to absorb this better. Morocco is an example of this, though their currency is managed. Yeah. So I'll leave it there, or maybe just to summarize, just say key warning signs for us in this, Natasha, is that debt service to revenue, basically debt service cost. If they are 30% plus, there are few markets on the continent that pays almost 30% of their budgets in interest costs. If the countries that have a high FX debt component, and we've seen that the CDS spreads, if the CDS spreads widens above 1,000 points, for us, those are warning signs. FX reserves depletion, those are warning signs. But if you look at the FX reserves across the continent, we've got, we talk about Kenya as one of the risk countries, but they've built up their reserves to about 6 months of net import cover. Countries like Morocco at 8 months. Nigeria is even more, at almost 11 months of import cover. So the buffers have been built in the past 2 years. So yeah, there are risks, but there are also opportunities. Thanks.
Yes. And then, Keo, you mentioned in sort of your opening remarks that before the war, many African central banks were beginning to ease sort of monetary policy. Now, how has the conflict disrupted the expected rate cutting cycle? And what does it mean for us investors across the African markets?
Yeah, this has fundamentally disrupted Africa's rate cutting cycle. It was almost synchronized. And I'll maybe start at the top. If you, at the beginning, we mentioned that 2024 was the turning point for most African economies, especially the largest ones like Egypt and Nigeria, where countries went into this big reform cycles where they basically reformed their monetary policies and their currencies. And post that, you saw inflation spike to almost 40% in these countries. And since then, inflation has been coming down. And if you look at January, February this year, in both the biggest markets, Nigeria and Egypt, inflation had come down. Talk about Egypt to about 11% by Feb. Nigeria was at about 13%. The direction of travel. Apologies. The direction of travel was positive, but the war happened, and maybe let me take it a step back. The phone call disturbed me a bit. Egypt had started cutting last year in 2025, and had already cut about 7-8%, from about 27% the interest rates to about just below 19%, below 20%. Nigeria had recently started cutting. Kenya had cut about 4-5%, actually more than that, in the last year. So it was almost synchronized. But then we've seen in April, most markets or most central banks put a hold on their rate cutting cycle. We saw Egypt central bank holding the interest rate. So the disinflation that we're expecting is no longer happening due to the high oil price. As you know, it fits into everything, into food, into fertilizer, and everything. So we think our view is that in 2026, depending on how long this war takes, if the war, like there's a ceasefire now, if the ceasefire continues and the Strait is opened and oil starts flowing, we think that most African markets will hold off this year on the interest rate cutting cycle, because I mean that those inflationary pressures will still come towards the tail end of this year, but then it continues into 2027. But if this continues for longer, then we think there's a high risk that interest rates on the continent might start going up again.
Thank you, Keo. Moses, I want to pick your brain on currencies. I mean, currencies are always a very contentious topic when you talk about African markets. So how are you thinking about this currency risk as a driver for total returns when assessing, the different markets or the different companies? How are you thinking about that risk in this environment?
Okay, thank you for that. I mean, just to highlight, what Kyo said in terms of the African continent, it's home to 54 countries, 54 different cultures and different currencies. And like you mentioned, if you're investing in Morocco, this is largely managed. So you get very, very stable FX. If you're investing in Kenya, it has been very, very resilient and stable over the last, I'd say, 2 years or so. Due to the reforms in Nigeria and Egypt, we've seen the currencies acting as shock absorbers for any stresses or any risks. So thinking about this question, and investing in Africa, we are taking a position on the asset as well as the currency. So it's like a two-faced investment. So you go long the asset and as well as the currency, you can go either long or short. So there are, as a result of the 54 countries being, we need to start thinking about Africa as different regimes in what they, in how they put out their policies. So policy credibility is very, very key. So there are divergent FX performances, like I mentioned in, Morocco, very stable. The shilling has been stable. The EGP, NGX has, is purely floating, the rand is floating as well. So we need to remember that, going long the asset and you've taken a position on the currency, any local equity returns can be wiped out easily by any FX depreciation. So we are cognizant in that. So we view and take currency risk very, very seriously. If you look at, like I mentioned earlier, that the African continent is largely an oil importer, currency risk therefore is tightly linked to oil exposure as well as external balances. So oil importers basically exhibit FX depreciation in current situations. We've seen the central banks also not only implementing inflation managing strategies or inflation targeting. Egypt is on the verge of implementing that inflation targeting within the country, but also currency stability is one of the important factors that central banks are looking to implement as well. Therefore, if you look at a country like Kenya, the shilling has been extremely stable, and this is a result of building up the reserves that they have and intervening within the market to ensure that the volatility within of the shilling is well managed, but not determining the direction as per the central bank governor. And finally, we view this as a total return. So you look at the local currency, local equity returns, as well as FX. So the way we do it, or the way you need to position yourself, is think about returns basically on the safest currency or perceived safest currency in the world, which is the USD. You look at the returns on a USD basis, and that takes into account the FX impact on the returns as well as the local asset return. So basically, I mean, long story short is that we are exposed to different divergent performances in terms of effects across Africa due to the fact that it is not monolithic, and one needs to take into account that total returns need to be on a USD basis or international basis rather than really focusing on the local asset return, because that can be easily wiped out by FX depreciation. So these are the things that we take quite seriously, and use that into our analysis of the stocks and companies and countries that we invest in across the continent.
Thanks, guys.
Yeah. Sorry, Natasha. I mean, just to add one on what Moses has said, and this is more like a framework of how we think about the currency on the continent. I mean, currently, oil exposure is the primary dividing line, single most important structural driver for FX performance in this environment. It's like net oil trade exposure. Exporters have support, importers face headwinds, and of course, I mean, this drives our country allocations on that. External balances, here we're talking about current account and reserve adequacy. I mean, current account deficits that are widening faster than reserves can absorb, then they create conditions for this already depreciation. So we tend to how we position on currencies, we tend to be shy of those countries, especially those that operate very close to the line, like 3-4 months of import cover. And policy credibility matters also. Markets tend to what central banks or countries that demonstrate inflation fighting credibility and active reserve management, like Morocco and Kenya, and currencies backed by a credible policy framework depreciates less. And this is also points back to the market that we've talked about a lot here, which is Egypt. Even though they are not yet in the inflation targeting environment, the country is moving that way. And this, of course, this current crisis in the Middle East has pushed that up a bit. But they've written this into their law now. They are moving into inflation targeting. Before it was money targeting, and so this amplifies also policy credibility. And Moses has already talked about it, that USD returns are what matters the most to our investors. So the most important discipline, I mean, for us in this environment is, USD returns. So yeah, that's it for me.
Thank you, Keo. So we've unpacked the impact that the war has on the African markets and the risk associated with that. And then an interesting observation is the divergence across African markets. And one can argue that this sort of dispersion creates investable opportunities. And as investors, I mean, we're always looking for opportunities. So Keo, as a seasoned portfolio manager, how do you exploit this divergence rather than just letting it sort of paralyze you at this point?
Yeah, for us, the divergence playing across the markets currently is not a crisis. Actually, we view it as an opportunity. And I mean, the key to exploiting is recognizing that Africa is not monolithic, like Moses mentioned, and that a blunt risk trade-off, risk sell-off of March 2026 created a lot of opportunities. Where we are seeing a lot of mispriced assets, and especially in the countries that are, oil importers. I mean, if you look at the continent along oil axis, the countries that are oil exporters have done well. Yeah, we're well positioned there. We've benefited, but you've seen that some of the assets they are becoming quite pricey, given the environment. While the markets that are net oil importers have been sold off indiscriminately. And we've been in this, like you said, Natasha, we've been investing in these markets for the better part of the last 20 years. And one thing we've learned is that when markets like Egypt, like Kenya, and get sold off indiscriminately, we know that there will be lots of investable opportunities that arise of them. We don't look at it as a crisis, but as an opportunity to pick very good assets at incredible prices in this environment. I mean, in markets like Egypt, we look at though they are a net importer, they are facing currency pressure from a high import bill, but there are companies which have high a solid pricing power that will be able to weather the storm. And those companies have been sold off as much as the companies that are exposed to a high the import bill. There are, for example, banks that have net FX exposures that will benefit from a weaker FX. I mean, banks always on the continent makes money in a volatile environment. Currently, we're having actually double win for banks. Banks that have net positive open positions on their balance sheets will benefit from this as they revalue the assets. The volatility in both the bond and the FX market creates an opportunity for banks to make a lot of money in that. So, and also interest rates now will be held off or start rising again. I mean, that's an opportunity for higher NIMs. So for us, we're looking at those kind of opportunities in this kind of in this market environment. And there are lots of companies on the continent that and USD returns, whether you're talking about companies that produces fertilizer in the markets like Egypt or oil companies in Nigeria that haven't re-rated as much. So those are also opportunities, investment opportunities that we look at. If you look at in the credit markets or the fixed income markets, I mean, here is where policy credibility matters the most. I mean, credits that have durable financing and liability management discipline are the kind of credits that we'll be looking at in this environment, and especially now that spreads have blown up, especially with the oil importers. Those that with policy credibility, solid reserves lines, I mean, and their bonds have been sold off aggressively. Those are the kind of opportunities that we're looking at in this current market environment.
Thanks. Thank you, Keo. And I guess finally, and just some thoughts from both yourself and Moses. What is your single most important message to investors that you would want us to sort of take away, just given that we are currently living through this geopolitical crisis? I'll start, Keo.
The most important message for us, Natasha, is that Africa is not a monolith. And in this environment, that distinction is everything. This war has created enormous volatility, but it has also created clarity. And the divergence between the Africans' strongest and weakest markets is now sharper. It's visible now. We can see it. And it has created a lot of opportunities that then didn't exist on the 28th of Feb. Like we said, I mean, the markets had been on a ripper, basically performing very well for the last 18 months. And the war came. There was a lot of sell-off. And even in companies with solid balance sheets, in countries with solid balance sheets, their currencies and their bonds were sold off. So this has created an opportunity that wouldn't have existed a couple of months ago. So for us, the main thing here is the discipline. I mean, focus on USD returns, focus on those companies that are mispriced, good companies that are trading at attractive multiples, the mispricing caused by this market turmoil. Yeah, and on the that side also, countries, good countries with credible policy that have been managing their debt very well. Yes, they are net importers, but I mean their balance sheets are solid, and their debt has been indiscriminately sold off. Those are the kind of countries we're looking at in this market environment.
Yes.
Yeah.
Moses.
Okay. Yeah, just to highlight on what Keo said and to add a bit, you know, when you look at Africa, you know, like he said, it's not monolithic. I mean, there's so many countries, cultures, you know, different central banks, policies across Africa. You know, initially, for example, like in Nigeria, when they were implementing their reforms, when Tinubu came to power, and, you know, if you compare where Nigeria was then and where they are now, and they've done significant work where, you know, they brought in a credible central bank governor. He is surrounded by a very, very professional team. They are sticking to what they're saying in terms of we are not going to manage the effects. That you know, that's going to act as a shock absorber for us. That immediately close the gap between the black market and the formal effects rate that you know, was published by the central bank. And you know, there were short-term, there are effects, you know, consequences, high inflation, but that has been coming down. But Nigeria, in terms of investability and credibility, has actually increased. You know, that just to give you an example. So in terms of what opportunities we're seeing on a country by country basis, and that's how we analyze Africa, is, you know, there are some countries that offer significant opportunity even within this chaos that's happening, even within this volatility, uncertainty with what's happening around this war. You know, there are some companies are some countries are offering significant opportunities. Some sectors, you know, we're expecting, you know, are basically doing very, very well. Like you say, the banks, we're expecting them, you know, to continue to flourish within this environment. If you are invested in a commodity-linked company, that should be, you know, positive. A company that has very strong pricing capability, pricing power, that is, you know, another factor that we look at. So market differentiation is very, very critical when you're investing across Africa, especially during this situation where significant uncertainty. It is chaotic, yes, and it offers significant opportunities amid this chaos. And finally, I'd just like to say that, you know, we've seen many of these regimes, you know, I started off in Nigeria in terms of what they have implemented in terms of reforms. You know, there are several sub-Saharan African countries, I mean, that they're doing the same thing in terms of reshaping their capital flows and funding models. So like I mentioned earlier, we're seeing due to the cautious perception by the international investors, higher cost of funding from external sources. We've seen many of these companies, many of these countries focusing more on domestic borrowing and building up their domestic markets. And that is positive for you know, domestic investors, the retail investors within that country, you know, and that will basically increase the base that's investing within the domestic markets as the government continues raising money through these avenues. So, I mean, we're seeing slowly and surely the African economies, you know, relying on themselves in terms of funding rather than, you know, going out there when, you know, post the global financial crisis when there was hot money and it was very, very cheap going and borrowing. But now we're seeing more credible regimes coming into play, the policies coming into play, and the domestic markets improving and building out, and the retail investors being part of that as well. It's very, very positive from where we sit. But we continually monitoring each country, we continue monitoring the policies that they have in place, and market differentiation for us is very, very critical, as well as the sectors that we decide to play in. Thank you, Natasha.
Thanks, Moses. Thanks, Gio, for those insights. I'd like to now open up questions. We do have a chat box, so you can just send us through your questions. I do see a couple here. I'll start off with the one. So, in your opinion, how away is Africa from being self-sufficient, where it extracts, refines, and consumes its own oil products? Let's start with Keo. Thank you.
Yeah, that is, I cannot tell you how far it is, but it is a possibility. Not to make use of a political slogan, in our lifetime. I mean, you look at Namibia. Namibia's first oil, I think, is 2029, 2030. There is a lot of oil deposits there that are being exploited. They're in the development phase. I mean, the deposits are significant, and I mean, Namibia is soon to be a significant oil exporter. So, yeah, the direction of travel is positive. Still on the same, I mean, you think about Namibia, I mean, that's on the Orange Basin. I mean, if you look just south of that or below that on the Orange Basin, there's even more deposit actually on the South African side, that they've been confirmed by Total. We just need, from our country perspective, just need to set up the policy framework and the fiscal terms of how those reserves gets exploited. So that's the other side. And then we move up into East Africa. Uganda, end of this year, will start exporting the first barrel. Like I said, that's the direction of positive. Currently, it's all about crude raw materials, but over time, we'll move into a more refined products on the continent. And we've seen this with Nigeria, where for the longest of time, Nigeria was exporting crude and importing finished products like fuel, diesel, jet fuel, fertilizer, and all this stuff. And since, Dangote, a private investor, invested $20 billion of his money and has taken Nigeria from being a net importer of finished product to a net exporter of finished product. So over time, and also, talking about Nigeria here, is that they have had their production has been stable for the longest of time. Yes, it come down, it's back up at about 1.7 million barrels a day, to trying to get it to about 2,000. But most importantly here is that the new law has been introduced in Nigeria since the new government came into place, which is going to encourage more investments into the oil and gas sector. And the interesting thing about Nigeria is that we've seen the multinationals leaving the onshore assets and selling them to the local producers and moving to bigger shallow water and deep water offshore reserves, where you can see, the future basically looks bright. You go to Egypt, Egypt on both oil and, what most people don't know is that actually Egypt it's supposed to be a net oil exporter, a net energy exporter, but due to previous policies that didn't work, it ended up being a net energy importer. Due to, like I said, due to the policies that didn't encourage investments, and actually discouraged investments. But we're in Egypt in Feb, and when we were there, the key thing was pay the oil and gas companies to start producing again and de-risk the exploration part of it. Basically, the government takes the first loss on exploration on both the Mediterranean and the Red Sea reserves. So overall, we're seeing a lot of African oil being discovered in a lot of African countries, and not only being discovered, but also those that were already producing, investing more to increase production. We are seeing investment into refining, and stuff like that. So we think in the next 10 to 20 years, Africa might end up being energy independent.
Yeah, just to add on to what Keo is saying, he touched on Dangote refinery. I mean, it's been, I would say it's been timely for Aliko in terms of, putting up a 650,000 barrels per day for refinery, and then this crisis happens, then, he's the source of, refined products across West Africa, and that's very, very positive. It also leads into why he's looking to basically increase the capacity to about 1.4 million barrels per day by 2028, and then going into producing plastics and other products within Nigeria. I mean, so he's invested a significant amount of money, but the opportunity within Africa is significant. Also on Uganda, not only are they going to produce, they've already built a pipeline that like Keo said, they're going to produce the first oil in 2026, but they're also looking to build a refinery by 2030 to have that operation by 2030. This is about 60,000 tons of barrels per day. So in terms of Uganda, a landlocked country that's heavily reliant on the port in Mombasa for its refined products, this is very, very positive for them in that they'll be able to supply or cover their domestic needs, which is about 42,000 barrels per day in terms of what is needed within Uganda, and export the rest in its neighboring countries. So we're seeing a lot of these regimes, putting up or going the extra mile in terms of value addition to ensure that they're self-reliant and able to export into Africa, other African countries, and thereby boosting the intra-Africa trade. And and this is the crux and of the Africa Free Trade framework that a lot of these countries have signed but haven't come into play yet. So this is a first phase. We're going to see that this coming through into other sectors like cement. You're seeing, Dangote Cement has grinders across East Africa, Southern Africa, West Africa, and he'll be able to move his products across other African countries, and this will be a big win for the African continent. And I agree with Keo, probably in the next 2 decades we'll start seeing and reaping the benefits of this, and winning Africa from relying on Europe and Middle East for our resources, and create the value addition in continent.
Thank you. And just the last question, I think we've got a couple of minutes left. How do you prioritize the relative importance of transmission channels in either commodities, capital flows, and currency? And how does that framework change across different types of events during this war? Either one?
Yeah. Okay. Firstly, I'd answer the questions. I tried to answer the question because I don't understand what you mean, the relative importance of transmission channels. I mean, when commodity prices, go up, yeah, she's actually not sorry. It's like, how do you prioritize the relative importance of transmission channels?
Either commodities,
in either commodities, capital flows, and currency flows, and how does that framework change across types of events?
Okay.
Maybe Poto can explain what he meant. Maybe he can unmute himself and explain to what he means. Maybe we'll be able to answer that questions better. Unless
sorry,
you
guys.
can,
Yeah, we're not able to do that at the moment, but it's fine. I think we can just reply to Poto, or maybe just get some clarity there.
Yeah.
Yes, Keo. So my question is more relatively asking, like, what is more important in terms of like commodities relative to like because you spoke on different types of things that would be affecting the the African markets. So specifically, I'd like to know how do you prioritize it? Do you think commodities are more important, capital flow is more important, or currency in
All
affection to the whole of it?
Interlinked.
all these are interlinked. There is, and also it depends. Countries are different. I mean, commodities impact currencies. Commodities impact capital flows, basically. So basically, this is more or less the same. Capital flows and currency is the same thing. When capital moves, your currency weakens, right? Or when capital comes in, your currency strengthens. So it's more or less the same thing. And commodities, it depends whether you're a commodity exporter or commodity importer. Commodity exporters, in a situations like this, when commodity prices go high, commodity importers will be net beneficiaries, so they'll experience capital flows, hence they'll experience strengthening currencies. So we don't, there's no relative importance for us. It is about whether you are an importer or exporter, in terms of commodities. The importers, in situations like this, they see capital moving. But even when capital is moving away from the net commodity importers, I mean, it is not about the general blanket macro event. It is about the opportunities that you still find within the country. Because yes, when commodity prices rise up, commodity importers will hurt, their fiscal balances will hurt, their current balances will hurt. Companies that are exposed to that will be those companies that we avoid, but there will be companies that actually benefit from that within the commodity exporter. Just like with commodity exporters, it does not mean that everything rises up in times of higher commodity prices. So it's about just looking at the individual opportunities within that countries. As much as we look at macros, we still bottom-up investors.
Thank you, guys. We are at the end of our discussion. Just maybe in closing, I guess the takeaway is that while the Iran war is a global shock, its impact on Africa seems highly differentiated, and within that dispersion, I guess, lies risk and opportunities. So it's just for us to assess the risk, assess the opportunities, and take them. Thank you, Team Africa, and thanks to everyone for joining us today. We really appreciate your time. And goodbye. Thanks.
Thank you, guys. Bye.
Thank you. Bye.
Thank you.